Investing is one of the simplest things you can do to grow your money while you sleep. You buy something, watch it grow, then hopefully you sell it when you're old. The concept is just so simple on paper, but once we actually get into the weeds of things, there are a lot more questions that we have to ask. Questions like, which stocks will grow over time? How do I know the stock I buy won't go bankrupt? What if the stock I buy doesn't do anything, just leaving my money idle for years? Questions like these is why exchange-traded funds or ETFs were created, so you can have exposure to a bunch of stocks just while holding only one ETF. In this video, we'll explore 3 different types of ETFs and see which ones are right for you. As usual, none of this is financial advice. I'm not a financial advisor.
Knowledge.
Now, there are 3 categories we're going to explore. There's just going to be the typical stock market funds, a growth-focused stock market fund, and then a dividend-focused stock market fund. And there are questions you'll have to ask yourself to see which one would make sense for you to invest in. You have to figure out, what is your goal? Do you want to aggressively grow your money while accepting more risk? Do you want to collect a little paycheck from dividends throughout the year without as much growth potential? Or do you just want a typical exposure to the stock market without leaning too heavy into growth or dividends? You need to identify why you are investing, and that will guide your decisions of which ones you will focus your investment in. So let's start with the typical stock market funds. You've heard of the S&P 500 before, which is the largest 500 companies in the United States. If you want exposure to some of the largest companies in America's economy, this is the fund for you. I mean, this is typical things like Amazon, Apple, Caterpillar, Johnson & Johnson. I mean, a bunch of large companies in this S&P 500. This fund averages a 10% return per year, non-inflation adjusted. Of course, there are down periods like we have seen in 2022, which we saw about a 26% correction from the top to the bottom, but on average you'll get a 10% gain per year holding this type of fund. Now, there are 2 main options you could do, which will give you exposure to the S&P 500. You have SPY, which is the SPDR S&P 500 ETF Trust, and you have VOO, which is the Vanguard S&P 500 ETF. Now, you can compare the weightings of the stocks in these 2 ETFs, but they're really the same. It's honestly not worth your time, in my opinion. They perform basically the same when we backtest them on a portfolio visualizer. But there are 2 main differences between SPY and VOO that we want to look at. One is the expense ratios, which is what you're charged for holding the fund. SPY's is 0.0945% and VOO's is 0.03%. So VOO's is much smaller, so you'll pay less if you're holding a large amount of capital in the S&P 500 if you're holding VOO. But I personally hold SPY. I don't hold VOO. And I like SPY because it has a lot more options volume. It has daily options, it has monthlies, weeklies, it has whatever you need, and VOO only has monthlies. So if you like options, if you wanted to sell covered calls on your S&P 500, if you wanted to try something like options, like the wheel strategy, whatever, it's going to be a lot easier to do on SPY than VOO. SPY has so many contracts, VOO has only monthlies. But if that's something you don't care about, if you don't want to trade options, you might as well opt into VOO for the lower expense ratio. If you buy either of these, you're betting on the American economy to keep doing what it's been doing for the 100 years, which is grow and make money. So if you believe in America, if you believe in the power of the largest 500 companies in the US, you believe in the power of the S&P 500. The second type of ETF to make you rich is a growth-focused ETF like QQQ, which tracks the NASDAQ 100, which holds some of the largest companies in the US. This is going to be heavily weighted in things like Apple, Microsoft, Amazon, Nvidia, Meta, things like that, a lot of tech. Now, since you're investing in growth, you can expect this ETF to increase in value much quicker. During the time of this recording in 2023, there has been over a 50% increase in this year alone compared to the S&P 500, which has had a 20% increase. So this is beating the S&P 500 by about 30% in a year. But along with the increased gains, we have to keep in mind this ETF is going to get more beaten up as well during downturns. From the high to the bottom in 2022, we saw about a 37% drawdown, which is 10% more over the S&P 500s. So keep this in mind. Do you like higher rewards with higher risk, or do you prefer less risk with less rewards? This is something only you can answer. Now, I have seen people recommend VUG, which is Vanguard's Growth Index ETF, but my question is, why? If we compare these two since 2004, which is when VUG started, QQQ has smoked VUG in terms of growth. A $10,000 initial investment in QQQ in 2005 would have brought you a balance of over $110,000 right now. VUG would have brought in just over $70K, and QQQ only had a max drawdown of 2% more than VUG. Now, QQQ does have a marginally higher expense ratio, but the gains are offset so easily. So in my personal opinion, not financial advice, QQQ absolutely destroys VUG. Significantly better returns, like not even comparable, with a similar amount of risk. So if growth is your focus, definitely check out QQQ. Do you own either of these ETFs? Comment down below. Lastly is a dividend ETF. If you want consistent payments throughout the year without a major focus on growth and you want to preserve your money, definitely check out a dividend ETF. In my personal book, there's only really one clear winner for this in this category, and that's SCHD, which is the Schwab US Dividend Equity ETF. SCHD has consistently raised its dividends since 2012 and has a current 3.63% yield, and has also grown in price handsomely since 2012. Now, SCHD has too many holdings for me to list, but it has things like Broadcom, Verizon, Home Depot, PepsiCo, Texas Instruments, many more. If you're interested in the holdings, I will have the link in the description, as I can't really cover them all in one video. It'd just be too long. Now, SCHD is really special because there aren't many ETFs that have increased its dividend over the years while also increasing in share price. Now, yes, the stock has stayed down since a year ago, but it's slowly creeping back up to all-time highs. But keep in mind with this, SCHD also holds up to market corrections better. As we see from the high to the low in 2022 is about an 18% correction versus SPY, which was 26%, and QQQ, which was over 37%. So if you're chasing a lower volatility asset that also pays you a dividend and continues to grow over time, SCHD is definitely your fund. Now, if we put SPY, QQQ, and SCHD into our portfolio visualizer and backtest since 2011, we can see this on paper. I guess on screen really, but whatever. SCHD has the lowest drawdown per year, but also is gaining the least compared to SPY and QQQ. It gives us the lowest balance. Then we have SPY, then we have QQQ. So the main takeaway with all of this is, how aggressively do you want to invest? Do you want growth with high rewards and a higher drawdown? Then look at QQQ. Do you want something like a middle of the road? Then check who's like a SPY or VU or something like that. Do you want income and dividends while also receiving slow growth? SCHD. Do you want all three of these and want to customize your portfolio to fit all these? Definitely do that. That's something you can feasibly do as well. Now, if you've been looking at all these but still don't believe me, these gains can make you rich over a long time, check out why I own the S&P 500 in my retirement portfolio right here. Peace.